Welcome to the Monday Call, brought to you by NZ Funds. I'm Stefan Clark, Chief Client Officer at the firm. Recognised by Citywire as one of the top female fund managers globally, and the only one based down under, our very special guest today is Kate Howitt, who until recently, having stepped down from her role, managed the Australian Opportunities Fund at Fidelity International, a global investment management business with more than 800 billion under management. Kate is celebrated for her fund's long-term performance and all-weather investment approach, with a deep understanding of global macroeconomics and a sought-after commentator in Australia on the share market, macroeconomics and sustainability, featuring in articles including the Australian Financial Review and other prominent publications. Today, Kate will be talking with us about her journey in finance, investment philosophy, advice for investors, and current economic insights. Kate remains active in governance and advisory roles today, including at the Boston Consulting Group. Thank you so much for joining us. It's really great to have you on the call. And I thought we would start with a little bit about you and how you decided to transition from consulting into investment management.
Thanks, Stephen. It's really great to be here with you. I'd actually take it further back than that. When I was growing up, I had no idea what I wanted to do, but I thought maybe I wanted to be a diplomat. So I started studying languages, and it turns out I was really, really bad at languages. And so I had to face the fact that that was just not going to work for me. And so then I really had no idea. And at this point, my parents had moved from Australia to the US. So I thought, I don't know what I want to do, so I better do a broad first degree. So I did a liberal arts degree. And I got halfway through that and realized that I was learning a lot, thinking about interesting things, but I wasn't going to be qualified to do anything that would let me pay back my student loans. And that was a bit of a sobering reality. I was about 20 at the time, and suddenly had to kind of confront the financial realities of life, that I was taking on a lot of debt and not going to have any income to pay it down. And so I realized I was going to have to get a qualification. And so I actually had a friend who was going to do an MBA. And I thought, well, that's the best plan I've heard. So I really didn't have a commercial bent. I was not, day trading as a teenager or anything like that. And I did my MBA at the University of Chicago. Really simple decision process after that. Chicago was just too cold to live in. So I moved back to Australia. And I really liked consulting. I joined the Boston Consulting Group. So I've had a very long affiliation with them. And I just loved what I discovered from my MBA was I loved looking at businesses. I loved looking at industries. I loved understanding what makes a great company. And so I started in consulting with how do we help companies become great companies? How do we help them on that journey? And I realized after a couple of years in that I wanted to be more on the inside. So I moved across to AMP, and this was about the time that AMP had demutualized and listed. And that was a big shock because here's a very old, very big, proud, insular company suddenly having the discipline of capital markets. And so I worked in the finance department there. And about a year after listing, they came to me and they said, hey, we want you to be head of investor relations. I didn't even know what that was. So it turns out investor relations are the people who help manage the company's interactions with institutional and retail shareholders. I didn't even know about that. So it was a bit of an interesting appointment on their part, but it was a lot of fun for me because I was then able to take what I had learned in business school and consulting about industry structure and competitive advantage, and then suddenly see how all of that played out in capital markets. And this was around 1999, so everything was very dot-com-y, and AMP was an insurance company, so no one was excited. It wasn't interesting, it wasn't fun, it wasn't hyped. And so, AMP had a really rough time on the markets, and, we had a really tempestuous relationship with our shareholders, and I got to be on the front lines of that. So it was one of those situations where you learn so much during really tumultuous times. But after a while, I looked at it and I thought, well, hang on, I actually think it would be more fun to be asking the questions than answering them, because when I'm answering the questions, it's just about one company. But if I was asking the questions, I'd be able to ask questions about all the different companies. And fortunately, AMP has its own internal, back then it was quite a big equities team. And so I was able to move internally into one of the institutional equity teams at AMP. And I just found that fascinating because they're, suddenly from talking about one company, I got to talk about 300 companies in Australia because I was looking at Australian equities. And then a couple of years after that, Fidelity decided to move its investment team to make it more local. And so they had coverage of Australia, but they were moving it from Hong Kong down to Australia. So they need to hire some locals. And I was hired on the ground floor. I was, I think, the fourth in the investment team in Australia. Yeah. And so that was now 20 years ago. And Fidelity is an absolutely exceptional company that really supports investment professionals well. And because it doesn't have a house style, it's not a growth house, it's not a value house. Fidelity's basic investment philosophy is back talented people and let them invest money in the way that makes sense to them. And that's how they'll generate the most alpha. And that was really important because the Australian market tends to be really bifurcated into growth and value. And the standard approach is to have a couple of growth managers, a couple of value managers, and blend them together. And there are merits to that approach, but in a really small market like Australia, I mean, Australia is so small. I had colleagues who were, global fund managers where their watch list was the size of my benchmark. And so Australia is a really narrow market, and it's got, a handful of really big companies, and then a really long tail of tiny companies, and then, 30 or 40 mid caps in the middle. And so I was really fortunate that Fidelity didn't make me be growth or value, because I just didn't see the point of that, because you're already in a narrow opportunity set. And if you then say, now I'm only going to look at an even narrower pool of opportunities, I felt like that was like, the economist thing of walking down the street and picking up, someone's dropped a $5 bill or someone's dropped a 20-cent piece. And that's what we're doing, right? I went to the University of Chicago, the home of efficient markets. There shouldn't be investment opportunities out there. Everything should be priced efficiently. No one should be dropping coins on the road. And yet when you're an investor, that's implicitly what you're doing, is saying, no, I think there are inefficiencies. There are things that are mispriced, and I'm going to go find them and pick them up. So I felt like if I was just going to be a growth investor or a value investor, it was like saying, I'm walking down the street, but I'm only going to pick up the silver coins. If it's a gold coin, don't care, because I'm a silver coin person. And I just thought, there's not that many coins on the road in this place. So that was, in kind of really basic terms, that was the approach that I developed, and that I was really fortunate that Fidelity would back me, because it's hard yards when you then try to get clients, and the consultants, the first thing they say is, well, are you growth or are you value? You say, I'm not really either. I'm trying to be style neutral. But I think that kind of set me up for the approach that I then took through the rest of my institutional portfolio management at Fidelity.
Well, you'll be relieved to know at NZ Funds we believe there's a place for all styles as well. So it's a like-minded mindset, if you will. You said I found it online, the dirty little secret of my career that I can let out of the bag now that I'm retired is that investing for me was just fun and interesting. I just love businesses, and I felt like, wow, I can't believe they actually pay me to do this. Well, that's a great start, right? If you've obviously got a deep sense of curiosity, and you clearly enjoy the process of discovery as a portfolio manager. How did you go from starting at Fidelity to developing that, or was it immediate, that deep love of the business and business development?
Well, like I say, that's been the thread throughout my career, is just this endless fascination with what makes a great company. And so, I explored that academically in my MBA. And then I explored that on the consulting side with BCG. Then I explored it internal to a company when I was working on the corporate side at AMP. And then funds management, you get to explore that by looking at all different companies. And so I would say, part of my kind of all-weather approach and not being growth or value was I wanted to own something in every sector, every large sector, and I wanted to own something in every size bucket, really large, medium, small. And I wanted to own kind of different sorts of business models, really mature ones, ones that are kind of really, reinvesting capital fast, ones that are early stage, ones that are late and competitive. I want to own all of those. And so how do you filter across all of those? And really the commonality was I was looking for great companies. Now, a great ASX 10 company is going to look really different to a great IPO scale-up company, a new green tech business or a med tech business or something. The characteristics of what makes them great are going to look different, although there are some commonalities. In all of them, there's a management filter. All of them, there's kind of a first cut of do I trust management to tell me the truth and to be good stewards of capital. So there are some commonalities, but that was the fascination I had. And so in funds management, that really blossomed into what does a great large cap company look like? What does a great mining company look like? What does a great startup company look like? What does a great infrastructure company look like? And I want to understand how those were different, and of the ones I had on offer, which was the best one. Now, of course, in investing, it's not just great company, because investing is what you get and what you pay for it. So you're looking for a great company at a great price. And Warren Buffett has talked about this he started off just looking for companies at a great price. And he ended up buying pretty rubbishy companies at super cheap prices. And then Charlie Munger helped him evolve over time to see actually you can do better by looking for great companies at okay prices. If they're really great companies, it's really rare that you get them at a really knockdown price. But if you can find great companies and then pay an okay price for them, then over time, those companies are going to grow their value, and the uplift in your portfolio is going to come from going along for the ride. So you find a great company, you become essentially a partner with management, and you go along for the ride as that excellent management team grows the value of that great company. So that was kind of the intellectual puzzle and the endless fascination. And I kind of couldn't believe, institutional funds management is such a privileged role. We get to meet with all of these people who are at the top of their game, running amazing companies and doing it really well, sometimes not so well. That's life. But they announce their results, and then like 2 hours later or a day or two later, they come and have a chat with us, and we get to ask them about it. And I just, this was brought to light one time. My brother was working for one of the big four Aussie banks, and I needed to pick up something from him. So I said, I'll meet you in the lobby of your building. So I went over and I saw him, and we had a little chat in the lobby. And the CEO of the bank comes down and he sees me. Oh, Kate, how you doing? You came over to put his arm around, because he wants Fidelity to buy his shares. He's very friendly. And he completely ignores my brother. And he's like, okay, great to see you, Kate. And off he goes. And my brother just stands there going, well, he's my boss's boss. He doesn't care about me, but he sure likes you. So, that was kind of my sense of, I can't believe we actually, get to sit down and have really interesting discussions about what's changing in the structure of your industry. How's your pricing power changing? How do you need to evolve your assets and your offering to your customers? Like, these are really, the world is constantly changing, and we kind of had a front row seat at the front of that, of how's the world changing and how are you responding to that to continue to build your ability to create value for shareholders.
And did your brother jump into funds management after that experience?
He was actually quite intrigued for a while, but he stayed on the management side ultimately.
Righty-ho. So how did your approach to investing, you talked about Charlie Munger and obviously going and accepting that you have to pay an okay price for a great company is better than paying a low price for an average company. Did your style evolve over time? Were there particular moments that caused you to have that epiphany, or was it that you just realized, hey, there are value traps, as they're often called, or it's cheap for a reason?
Yeah, no, so I wanted to own all those sorts. I didn't necessarily want to own rubbish businesses, but I wanted to own, if you're buying. So I always had in my mind a kind of 2 by 2 matrix, which actually was a bit of a, borrowing this concept from BCG. BCG has a thing called the growth share matrix, and my view of that was the vertical axis is are your returns high or low? Are they kind of sustainably above your cost of capital, or are they kind of around your cost of capital? And then the x-axis is what's your ability to redeploy those funds, and you get kind of 4 really obvious boxes. So there's ones that are low returns but high growth potential. So these are companies early in their stage, so like a startup where they've got negative returns because they're not at scale yet, but they've got a lot of potential. And then, above that, you've got companies that are, kind of classic growth companies, which have high returns and are able to reinvest those returns. So, in the Australian market, you think of a company like Seek, started off very small, but its returns were, in the 30s. And, for its, easily its first decade, it was able to then redeploy those returns into growing its asset base also in the 30% per annum. And that just compounds value. So those are really wonderful businesses, but they tend to be always quite richly valued. Then as companies mature, they kind of move to the left, and they've still got high returns, they've still got competitive advantage, but their ability to reinvest and grow diminishes over time. And there's if you think about how Woolworths had super high returns, but just can't really reinvest too much, and so their growth rate kind of gradually slows down, even if their returns are still quite high. And then you get companies where, they get even older, their competitive advantage gets eroded away, and then they kind of fall down to kind of, what I used to call tortoises, where they're, the returns are around their cost of capital. And because their returns are not that high, they've got no surplus value they can reinvest to grow. So they're more just like an annuity unwinding. So that puts you into kind of classic value territory. I was quite happy owning any of those. And I kind of had a 5th category that kind of snuck in there, which is roll-ups, which are companies that might not have incredibly high returns, but they can manufacture their own growth by buying up their smaller competitors in their space. And, a great example of that is the insurance brokers like Steadfast, where they just keep incrementally buying in more insurance brokers. And they do have, reasonable, not 30% returns, but returns, solidly above their cost of capital. So that roll-up does add value. There are other bad roll-ups where they just buy to become bigger and they're not adding value, and those tend to end in tears. So I was quite happy owning all of those different ones. And in fact, I quite liked the variety that, you've got to kind of, they're different models. And so when you're trying to assess the risks of, Seek, that's really different from trying to assess the risks of Woolworths or the risks of Steadfast. They're quite different businesses, and what you're worried about, is really quite different in each case. But so I didn't really have. I mean, again, it all comes back to running money in Australia. What I observed was my colleagues that ran global money, where they've got thousands of stocks to choose from, they tended to have a really high style bias and a really kind of narrow filter of, they were all looking for their own kind of personal, one guy liked companies that were just like this and would kind of look all across the world for them. Whereas because I, was stuck in such a small little pond, I was prepared to look at all different sorts of opportunities.
Did you ever assess which quadrant or box was most successful for you?
We did at one point look at those first ones I talked about, which we call pups, which are, ones that have a lot of potential. But, the risk there is that that's not a stable situation. You can't sustainably grow beyond your ability to self-fund it, because to invest that capital, you've either got to raise equity or raise debt, and that's very precarious. So we looked at those companies, And about 80 to 85% of them on a kind of 5-year basis blew up. So a very high mortality rate for pups. So the whole thing there was just find the ones where, on a 5-year view, that hockey stick, they're all in this kind of, I'm investing money now, but it's all going to come really good in the future. And the trick was to find ones where that hockey stick would actually play out, because most of them would either blow up and not be able to fund their growth, or they would fund it through so many dilutive equity raisings that even if they kind of got to a scale business, the early investors would be diluted to nothing, and really, the share price would go nowhere. So those ones were much more binary. If you're looking at the cash cows like the Woolworths, they're not going to blow up. They might have a surprise announcement and they might fall 20% or something. But, if you stick with them, generally they'll make it up through time. So they're just different characteristics.
Yeah, okay. You did have a leaning towards smaller companies, though, even though obviously in Australia there's not that many big ones, and you're benchmarked against the ASX 200 accumulation index. So how did you benchmark yourself? Not so much formally, but how did you decide whether you were tracking in line with what you're wanting to achieve?
I never felt like I was doing well enough for my clients. I had a really keen sense that I had the retirement savings of Mum and Dad Australia, and that they had entrusted me with their funds so that they could have a better retirement. I never felt like I was doing well enough for that, and I always wanted to do better. But, kind of another little secret of my career is I never looked at my performance. I felt like it just wasn't going to help me. Very early in my career, someone in Fidelity on a Thursday morning would send out a weekly performance report of every portfolio manager in the place. And so, it landed in my inbox. And so I started looking at it, and you'd see everyone else, and there'd always be people there having a cracker, who their portfolios are up a couple of percent in a week. And what I realized was that, I think emotions generally are, can be helpful, but largely can be unhelpful. So what I realized from that was that every Thursday morning I would open up this email and I would become either happy or despondent. And neither one of those helped me analyze stocks or make better stock calls. So I stopped. I just blocked that email and just stopped watching it, because I thought there's no point if 2 days out of every week I'm not in a good headspace to be able to do my job. And I spent a lot of time, and of course, during the course of my career, behavioral finance became a field, became a thing. We evolved, our brains evolved to survive in the savannah. And our emotions evolved to prompt us to take action. Is that a tiger in the bushes? Oh my God, quick, should I run? Should I not run? So that kind of mechanism might have been adaptive then, but it's not adaptive for being a good investor. So Danny Kahneman, the kind of father of behavioral economics, wrote the book that's now a classic called Thinking Fast and Slow. And so we've got our fast brains that are constantly reacting to tigers in the bushes, and then we've got our slow brains that are helping us weigh up whether it's right to take a non-consensus view and go against the herd and sell the stock that everyone loves and buy the stock that everyone hates. And I just realized that even looking at Bloomberg all day long, I think it's pretty standard practice to have a screen up all day long with the stocks that you own. You think that's being responsible. But actually, Nicholas Nassim Taleb in The Black Swan talks about signal and noise. The more frequently you look at a data set, the more you're looking at noise, not signal. So you want to slow that down. So I would look at my positions in my stocks, maybe once a day, or if I was actually doing work on them, but I didn't have that watch list up. And the best investors inside Fidelity all would say, don't have red and green flashing on your screen all day. All you're doing is triggering that primitive part of your brain. You're just triggering the system that wants you to constantly be fight or flight, and that's not conducive to sticking with your winners and making good investment decisions. So I didn't actually look at my performance. I didn't watch my stocks all day long. And I think that's part of what you have to do to carve out the time that you need to really do the quality thinking.
Interesting. So you mentioned earlier that your relationships with management were really important, and presumably from being an investor relations starting point, you knew what was very relevant to the businesses you're investing in. How did you go about building those relationships? And I saw in researching for this call that you have voiced, and I guess you touched on a little bit earlier, you have to be mindful of who you're talking to and what they might say.
Yeah. So you're exactly right that my starting out doing investor relations really shaped how I think about interacting with management. And it also goes to this point that I made about the privilege of interacting with these guys. I say guys. Fortunately, there are more women now, still not enough. Because in the industry, we tend to have kind of 28-year-old analysts who sit down with CEOs and kind of give them a hard time for not doing a better job of running their multi-billion-dollar empire. And there's a little bit of, there's a right way and a wrong way to do that and to have that conversation. And then over the top of it all, you've got continuous disclosure and insider trading. So you're having meetings with management. You can't go in there and say, hey, are you going to make a bid to buy company XYZ? Because if they are, and they tell you, they're breaking the law. We have continuous disclosure obligations. They cannot tell you something that they haven't told the whole market. So you have to learn how to ask questions that management could actually answer. You can't say, are you going to buy that company? But you can ask, if you were to buy that company, would there be a lot of synergies or not much? And if the CEO says, yeah, don't know, I haven't really thought about it, they're probably not buying it. If he says, do you know, it would be amazing because we could put this with this and we could cut these costs and we could realign this, then you know it's on their radar screen. So that's part of it, is asking questions that can make it a productive meeting, not just a stonewall meeting. And then part of it is how do you, when you own shares at institutional levels, you get large positions and you're there for years. And sometimes things go well and sometimes they don't go well. So there's a question of what do you do when you own a company and they do something that has sent the share price down 20 or 30%. And it's really tempting to go in there and tell them what idiots they've been. And you're in the position where you can do a bit of that if you want to. And there are plenty of investors I saw as an investor relations person in a company that was sending its share price down, not by intent. We had a lot of shareholders who would just come in and spend the first half hour berating us. And I would sit there and go, how is that helping your clients? How are you doing your job? Because all you're doing is making the CEO so defensive that even once you get all that off your chest, and we do get down to you asking him some questions, he is going to parrot exactly word for word the public releases. And this whole meeting is going to be a waste of time. So there's a real, it's just, that's not any different to any other aspect. If you're having meetings with people, generally, you catch more flies with honey than with vinegar. Alienating people from the first gate, even if you're in a position where you can do that, is generally not going to get you what you want. So I did feel like, A, it was a privilege to have these times. B, to do your job on behalf of your clients, you need to kind of ask questions in a way and conduct the meeting in a way that is going to help make it a good use of time. Otherwise, don't waste anyone's time.
And did you find yourself in situations where you felt like management weren't telling you the story that was the real story?
Oh, sadly, that does definitely happen. It's generally, my experience has been like I've had one or two experiences with out and out crooks, and fortunately in this market, you do get ASIC coming afterwards saying we'd like to see your notes from that meeting, and so we are fortunate. Part of why Australia is a good place to invest is that we do have robust controls on our capital markets and management teams who do outright lie. Our corporate regulator is not shy on going after them. So that's good. Um, you can find that, there's a lot of the duck is on the water and looks like it's serene but is paddling really hard. So more often you get situations where something's not going quite right in the company and the management team are paddling really hard and they want to get it under control and never have to really talk about it and air their dirty laundry. But sometimes things get away from them and they can't get it under control and it ends up coming out. Um, and the even more common, so I developed various rules over my career, and Kate's rule of market announcements was if a company does something you think is dumb, like buys a business that you think, well, that doesn't make any sense.
It's on the dumbometer, isn't it? It's on the dumbometer. It's like very high levels of dumb or low levels of dumb.
The typical response is to go, oh, that CEO's an idiot. Why is he buying that company, right? And Kate's rule of market announcements is if a company does something you think is dumb, odds are they're not idiots. You don't generally get to run publicly listed companies by being an idiot. Odds are you just haven't understood the base case. So when a company goes and buys a company and the market goes, oh, that's a terrible deal, it's because the company has identified that their competitive advantage is eroding, they're becoming irrelevant in their marketplace. But surprise, surprise, they don't go out and trumpet that to their investors. They don't tell investors, wow, we are really losing ground. Things are getting desperate. So the company thinks the option of buying a business is bad. What they don't understand is that the do nothing case is even worse. And management knows that and haven't told. So you see that quite a lot when the market gets surprised by various initiatives the companies announce. It's because they haven't actually figured out for themselves that the do nothing is looking pretty grim for that company.
The alternative is uglier or dumber, perhaps.
And so, you do have to, to some extent, CEOs are salespeople. They're selling their equity. They're, making it look really good. They're putting it in the best light so that you want to buy it. So even the best run companies, now I would say for CEOs, the main advice is to play the long game, which is don't try to make people like your company in the short term if that's going to disappoint them later on when these things. So the management teams that do come out and are upfront about the fact of we've got an issue here, we might have to do something about it. I reckon there's a couple of PE points in winning credibility with the market as someone who will give you the bad news. But it's still kind of surprising to me that not all management teams get that. And so it's still reasonably common for CEOs to think through the short-term aspect of I'm selling my equity, I've got to put a good spin on this, and to miss the bigger prize, which is if I'm upfront and develop a reputation for real integrity, then my shareholders will stick with me through whatever challenge we're working through.
Yeah. And I guess when you are an investor with a longer time horizon, like you would have been, you develop a real relationship. It's not by no means a fly-by-night relationship. It is a 5-10 year journey deploying your capital into that company. And so integrity and trust and so forth, underpin parts of it.
Yeah, I mean, the interesting aspect of that is it's even more so than that. So there are companies where I was on my 4th chairman and my 5th CEO. I had companies, there was one very large company where there was a new CEO announced, and before he took over, he said, come have a chat. Tell me the history of my business. give me the context that I'm about to run this business in. And so, it's actually where, particularly if you have something really tumultuous happen in a company and they can do a clearing of the decks and you can lose, kind of a generation of board members and a generation of management. And it ends up where the long-term institutional shareholders are the ones who remember. And it's quite funny because you can get companies come full circle. They go back and make the same mistake 10 years later because there's no one in the company who was around back then to remember that mistake. And yet shareholders can see it happening again. I go, wow, right now we're all trying to figure out a way to decarbonize steel production, and kind of the most technologically feasible way to do that is direct reduced iron into hot bricketed iron using hydrogen, and of course BHP did that. In the late 90s, BHP did an HBI plant. And a year after they commissioned it, they wrote the whole thing off. And then a couple of years after that, they shut the whole thing down because they had a fatality, because it turns out hydrogen is really combustible. So, you can everyone can get really excited about, let's do HBI with hydrogen. And you go, well, we have actually tried that once in Australia. It turns out it's actually really tough to do. So you do find that institutional shareholders can have really long memories.
Over time, you have expressed the importance of patience in investing, and small caps, which they tend to be, we expect a higher growth rate of them often, and they're longer holdings, but not always. How do you sort of balance off the importance of patience with your own investors' investment expectations and your own performance expectations with, I guess, things moving so quickly?
Yeah. So we, inside Fidelity, many years ago, someone wrote a paper called "Where Are All the 10 Baggers?" Right? Now, 10 bagger is like, US investment speak for, something that goes up tenfold. And what this person did was went and looked at 10 baggers that had been captured in funds. And the thing is, it takes a long time. Right? Nothing is a 10 bagger. Well, I say nothing, but these days, with kind of meme stocks, who knows? In the normal course of events, nothing is a 10 bagger on a 12-month view. To get a 10 bagger, you're going to hold it for 7 or 10 years. And so that's, again, this is, one of the real strengths of Fidelity is you kind of this institutional orientation towards long-term ownership. And I think there's a really strong temptation, and like trading generates a lot of noise, a lot of news, a lot of excitement, and so we can really confuse trading with investment. So I kind of think of trading as, here's a stock, it's trading below its intrinsic value, I'll own it, that'll close in a couple of months, and I'll flip that into another similar position. I'll just keep doing that. So it's actually quite a high turnover business. I think of investing, and this is not a kind of black and white distinction, but investing is more, here's a great company, it's going to grow its value for 10 years, I'll buy a piece and I'll go along for the ride. And so when you look at what moves the share price on a 12-month view, it's like 90% is PE and 10% is the earnings. But when you look at it on a 10-year view, it flips, and it's like 90% earnings and 10% PE. Now the PE, really hard to predict, because market, Mr. Market gets manic, Mr. Market gets depressed, the PE can go up, the PE can go down. Really hard to get conviction on that and predicting market sentiment. It's, Fidelity always found it's a lot easier to do your spreadsheets, do your MPVs, do your modeling, talk to management, figure out the industry structure, and you can then forecast kind of EPS on a kind of 10-year view, value creation, who are going to be the winners in their industry on a 10-year view, and then you place your bets. And it kind of comes back to the question of, short-term, long-term orientation, is, you place your bets on a 10-year view, and then you just stick with it. And that in the short term, the PE is going to go up and down, and that position is going to swing. But if you're not invested for that, if your thesis is, I'm owning the winner in this industry on a 10-year view, that gives you the patience. Now, on your question of how do you do that with small caps? So, pretty much everything I was buying on a 5 or 10-year view. The larger companies, that's more predictable. And, kind of more sleep at night. The smaller companies, so I used to think, large companies, they're like cruise ships or oil tankers or aircraft carriers, right? Like once you kind of figure out the direction they're going to keep going, and it takes a lot to knock them off course. Small caps are like speedboats. Any kind of big wind, a big, wave can kind of like make them have to pivot and turn around. And so like, it's a lot harder to predict. And so you do have to be more nimble. And both of those observations lead to my conclusion of bet sizing. A larger, more stable business that is accreting its value for 10 years, you can own a lot of. A smaller startup, earlier stage business is a lot less predictable. So you can do all the work you want. The proportion of what's knowable and what's unknowable is a lot different, and you just got to have a smaller bet size, because you can be patient with these small companies. They can have a hiccup. You can give them the benefit of the doubt and not want to sell into a low, and some of them recover and some of them go to zero. And that's, that is part of institutional investing. Some of the companies you hold, they go to zero. And so there, it's just really, your bet sizing. I own Woolworths. I'm pretty confident Woolworths is not going to go to zero. I own a small startup. There's a non-negative chance it could go to zero. So I'm not going to own 500 basis points. I'm going to own 20 or 30 basis points. So I own more small companies, but I generally own them in much, much smaller bet sizes. So the aggregate, if you were to do, the kind of weighted size of my portfolio, it would have been pretty big. But in terms of number of names, so I had, it was kind of this distribution. I had a couple of larger names that I owned a lot of, and then a tail of smaller names that I owned, much smaller positions, but enough to give me exposure, because if they doubled and doubled again, then it would become quite meaningful. But if it went to zero, it wouldn't kill me.
There's always a temptation when a smaller or any company, but is so position sizing, and when you put your position on is obviously super important. But when you're on a 5-10 year view and say one of your businesses performs very well very quickly, gets re-rated, market suddenly says, hey, we see what's happening here, we really like it. How did you think about selling early when you, or not at all? Would you always hold on? A lot of people seem to find buying easy and selling hard.
Yeah, because there's endless room for regret. The one that you trim is the one that goes on to double and double again. The one that you don't trim is the one that then falls 80%. There's no kind of hard and fast rule. I felt that there was a real distinction between stock picking and portfolio construction. Stock picking is just looking at each stock individually. Is this, what's the risk reward? What's the value creation going to be? What do I think of management? How's it going to play out? Is to buy or sell. Portfolio construction is, how do you put all the pieces together? So, you've got 100% of the portfolio, how much should be in which and why? And these days, the standing, most portfolio managers would say, I'm a stock picker. I have my best ideas and I just own a lot of them. And they actually don't think of portfolio construction as a separate discipline to put on top. I found that portfolio construction was helpful in making those decisions. If you own something and it goes up enough that it becomes a bigger weight of your fund than you're comfortable with the new risk reward of that stock, then you sell some.
I guess it comes down to how you see your role as a portfolio manager, because if you're assuming that, say, financial advisors are going to do the portfolio construction, then you're just to deliver on your mandate, and the advisor, together with the client, can decide on what the weighting should be to your fund. Whereas if you, like you do, and we do too, we see each fund as having a particular role, and within it, you need to take into account portfolio construction, position sizing, risk-adjusted return profile, all those sorts of things. I guess it takes more work, but it's arguably less myopic. Your role plays a part in something, and you need to be clear about what that is.
Yeah, I think that's true. And on the institutional side, you get traction over time by having a repeatable process. So that guys like you can say, oh yeah, I know what role that portfolio is going to play, rather than kind of, changing strategy through time.
Okay, hey, let's move on to where we are today in the world, the big wide world, and particularly Australia. How do you see Australia's place in the economic world today? And comparing it, for example, with New Zealand, I understand Australian inflation is still really strong, and the RBA probably needs to do more. And growth is holding up okay, but it's there's some tailwinds and some headwinds. New Zealand's in quite a different space, and growth is not holding up that well in spite of all the immigration. And there's, I guess, a commercial or an economic malaise that's sort of sitting over the country at the moment. And then obviously America and China and all the dynamics there are in play. What's your sort of big picture take on where Australia is going from here?
Yeah. So Australia and New Zealand are both small open economies, but we have really good institutions, good rule of law, efficient capital markets, deep pools of capital relative to our size, but still fundamentally importers of capital for capital deepening. So I think that's, like that kind of robust underpinning to capital markets is often overlooked, but actually becoming kind of increasingly rare. And is a big part of our appeal, to my former global counterparts when they're thinking about investing into Australia. But still, large open economies. The Australian economy used to kind of be two halves, which was kind of mining and everything else. And the mining cycle would do what it would do, kind of boom and bust. And the job of the RBA was really just to push against that. So when mining is booming, you kind of have to smush everything else down so the economy doesn't overheat, like when all of your tradies are going out to do FIFO jobs in WA, and vice versa. When mining's in a slump and things are being closed down, people are being laid off, then you need lower interest rates to stimulate those tradies to come back to the East Coast and build houses again. It was kind of a simple equation. It's been a little bit muddied by immigration becoming a bigger swing factor. And so now you've almost got two factors, two cycles going on. You've still got the kind of boom and bust in WA, but now you've also got more of a kind of boom and bust with immigration, it tightening up and loosening demand at various times on the East Coast. So that brings you to the standard interplay between monetary policy and fiscal policy. And Phil Lowe spent a good part of his tenure, with interest rates rock bottom, saying monetary policy can't do everything. We need some fiscal stimulus. Are you listening, Canberra? And so it's quite ironic that then his tenure ended when that flipped around and he actually needed to do the tightening because Canberra wasn't doing the tightening. And then Canberra said, "Oh, we don't like you raising rates. See you later." Phil Lowe, I think, did kind of exactly what his role was supposed to do, and was kind of caught in that, cycle, even though things played out the way they should. So, interestingly, the government, both at the state and federal level in Australia, are still doing pretty stimulatory budgets, with the exception that they're now going to pull back on student migration. So kind of the wash up of drastically pulling back on student migration, but still kind of pumping up a lot of support to households. The wash up of that is, what the RBA will be looking at to see, do they need to tighten? Because the current, Australia also has some of the really best monetary policy transmission mechanisms in the world because still, 85% of mortgages are variable rate, and the banks adjust their lending rates very quickly after Reserve Bank moves. So when the Reserve Bank taps on the brakes, it gets transmitted through to households very quickly. You compare that with the US, where most mortgages are fixed rate and very long-term, priced off at least the 10-year. And so the US Fed can tap on the brakes and it does nothing. It literally does nothing, and which is why they ended up with quantitative easing and all kinds of other workarounds to try to bring down the long end of the Treasury curve. So, that's great. We're in a great position where you do have an economy that's responsive to monetary policy. You do have an independent central bank, and the saving grace of Australia, for at least the last decade, has been the ongoing kind of insatiable demand from China for our iron ore and the huge revenue windfall that brings in to the western half of the economy. That's really underpinned everything. And so, we've got issues to manage at the margin, but our prosperity has been fundamentally very strong.
Yeah, the lucky country is called the lucky country for a reason. And it's surprising to see that, the talk over there of inflation not coming down at the pace you would like. It's quite different from how commentators talk about it in New Zealand, at least at the moment, and obviously in Europe and other countries too. So that just, I guess, is a reflection of that relationship with China, and also all the other, for its size, such a big pool of capital still working and investing and growing and creating jobs and everything that a good economy should do. When you think about macro factors, how did you overlay that in your portfolio? And were there particular indicators that were really prominent in your thinking? Because as a stock picker, you're sort of sitting at that micro level for the most part, but the tides move, and ultimately you need to take them into account.
Yeah. So again, that kind of comes back to my, the point that I made about trading versus investing. Is there's a lot of trading these days, which is also kind of macro trading of predicting which way a macro variable is going to go, and then placing a bet via companies or ETFs that are exposed one way to the other of that. And that's certainly, that's a way of investing capital that I always felt like I had no particular, I was good at analyzing companies and industries. I wasn't good at predicting macro factors. So my response to that was to try to internally hedge that. So, one of my portfolio construction lenses was, what is my exposure to big macro factors? The exchange rate, interest rates, and to try to, roughly, have something that, would balance each other out. So I used to kind of say that I wanted investors to look, like if you look at the top 10 holdings in my portfolio, you shouldn't be able to see a macro view expressed. I never wanted to be on one side of the fence of, clearly I own all these stocks that are going to do really well when interest rates come down. Because I felt like then I wasn't doing my job. And so I always said I wanted my portfolio to, be nicely schizophrenic. Things that would do well when inflation went up, things would do well when inflation went down. And where both stocks were individually, intrinsically good companies run by good people doing their thing, but had opposing macro exposures, which is, kind of another aspect of being an all-weather fund. In the same way of I wanted to own large companies, I wanted to own small companies, because there are times when large companies do well and times when small companies do well. Times when defensive sectors do well, times when cyclical sectors do well. And so I kind of just wanted to have a bet each way on all of those to kind of smooth that out in the portfolio.
Okay. Look, you've obviously done a lot of thinking around how you believe, portfolios are best constructed and obviously had great outcome through that. When you're thinking, and I'm sure lots of young aspiring portfolio managers talk with you, are there particular pieces of advice that you convey that you wouldn't mind sharing?
Yeah, I've got two.
Two doozies.
I haven't answered this over time. Investing is a learning by doing thing. There's that great Yogi Berra quote, in theory, there's no difference between theory and practice, and in practice there is. So you've got to do it. You've got to learn it. You've got to lose money and go back and invest more, because a lot of it is an emotional game. Learning to be contrarian, like no one is born feeling great going against a crowd. We're mammals, we like to herd. And to do well in investing, you've got to be able to unherd and do different, whatever. And that's an emotional state. Can you hold an investment when it's falling and falling? And can you figure out whether you should buy more, whether you should sell? All of those things are processes that you've got to experience yourself. And so no one really knows what it's going to take for a good stock picker. And so you kind of just have to give people a go and watch them do it. So the way you de-risk yourself to an employer is you start investing for yourself so that you can then say, hey, I've learned some of that stuff on my own time. You don't have to take all of that risk. I've already learned some of that myself. And the trouble is, if you're young and you're starting out, you've got no money. You've kind of, you kind of just trying to, get yourself started financially. That's fine. You just keep a notional spreadsheet, but you sit down, you take one Saturday a month, you pick a company, you sit down, you work it all up, you decide for yourself, is this company a buy or a sell? And if so, why? And kind of what price do I think it could go to? What price would I be a buyer? And you put a line in the spreadsheet saying, on this date, I notionally bought or sold company X. And then you watch it over time, and that's how you learn. Now, you're not going to learn as well than if you're actually putting some money into it, but small amounts are fine. Because you're not, like it's inefficient, your trading costs are high relative to the money you put at work, but you're still really learning. So if you can't if you're not interested enough to do that, then maybe you should reconsider whether you really want to do this. If one Saturday a month is too much, or you find it boring, or you can't make yourself do it, well, then probably, maybe this job is not for you, because it is a self-starter job. You have to be self-motivated. No one is going to tell you, go look at that stock because you'll make money there. You have to figure that out for yourself. You have to have the motivation and discipline to go do that work yourself. So that, I think, is a really good test for people to put on themselves. And then also something, really great to talk about to someone that you want to hire you for this. And you'll just learn. So even if you're just going to invest for yourself and you don't want to do it professionally, how are you going to learn? You learn by doing. You learn by having a go and going, oh, I bought that company and wow, I look back and I can't believe I just was caught up in the hype, and clearly with hindsight, it was way overvalued, and you learn from that. So that's my first piece of advice. Just have a go. The second, and just as a kind of adjunct to that, the book, of all the investment books out there, the one that I found really helpful, two, Peter Lynch, One Up on Wall Street. So it's an old one, it's a classic, but it's about investing in things that you know and can see around you. You go to Woolworths every day. You can invest in Woolworths or Coles. And then the second book is Michael Mauboussin's Expectations Investing, which is about figuring out what's already in the share price. And that's a really fundamental bit of actually, is the stock a buy or a sell? Well, what's priced into it? How much optimism is already in the share price? And that book kind of shows you how to do that. So those are my kind of, entry level books. And my second is read The Economist. When I was doing PhD level economics at the University of Chicago, which has more Nobel laureates in economics than any other institution in the world, they would assign reading from The Economist. And I was like, wow, this must be credible work. And so the Economist sometimes does deep dive into economic things. Great. But it's a weekly news magazine. I don't read all of it, but I have read the relevant bits of it, for over 20 years. And it's not cheap. They do student subscriptions, but it's not a cheap one. But I did a kind of retrospective for some women about how I got to where I am. And I was like, so I could have bought a really expensive pair of shoes every year and, watched a couple of hours of Netflix every week. And instead, for 20 years, I chose instead to buy an Economist subscription and, read the business section, the finance and economics section, and the big, the American and Chinese sections. Because when you're early on, you might get a lot of theory from your education. But what's really helpful for your employers is if you actually bring a perspective to the table. And Australia and New Zealand are very small economies in the scheme of things. They operate in a larger global context. And so understanding what's going on in that global context can really set you apart from the crowd, give you a perspective that other people locally aren't seeing, and help you make better decisions and add more value for your employer and make better investment decisions. So I find it an interesting read, and they do a lot of surprising articles that are not just dry business finance things. So I don't find it a chore.
I too am a long time Economist lover, and currently don't have a subscription, but will have had them many times in the past. What I agree with everything you've said. What I would add to it is the beauty of it is that everything is in as few words as possible to convey the message. So if you're going to try and get a lot of information about a lot of different topics in a short period of time, that is a beautiful place to start.
In fact, Nicholas Nassim Taleb uses it as one of his examples in The Black Swan of signal versus noise. He says if you read newspapers every day, they've got to fill the paper. So there's some signal, but there's a lot of filler. That's just noise. Whereas if you read it weekly in The Economist, they've had a week to distill it down to what actually matters. And so I would agree, and my phrasing of that would be, the signal to noise ratio is a lot better in The Economist than a lot of other publications you could read.
That's the difference between the cost of a newspaper and the cost of The Economist. The margin, the premium you pay for less. Okay, my last question is one that's, and I know it's dear to your heart. You've talked about this many times, and from my research, but there's not a lot of females in finance. Not as many as we would all like. What do you think we need to do to change that?
Yeah. I think partly the finance industry does a bad job of the way it portrays itself. Finance is most fundamentally about solving problems for people. If you've got a retiree who's got a lot of excess savings, they need a return. If you've got a startup company that needs a lot of money to be able to prove up a way to make carbon-free steel, finance exists to put those two together and solve their problem. They can't solve their problems individually, but finance can intermediate and put those two together and can give the retiree the return that they need and can give the steel company the investment capital that they need. That is most fundamentally, you heard it here first, finance is a helping profession. But we never talk about that, right? It's really obvious the value to society added by doctors and teachers. Ask, a teenage girl in high school, they'll be able to articulate that for you. Ask them the value to society by banking and finance and capital markets. They won't be able to tell you because no one ever talks about it in those terms. So when you are a surgeon, you can make some really good money. Sadly, when you're a teacher, you mostly can't. When you're in finance, you can make some really good money. We don't talk about, I want to be a surgeon because I really want to do well and make money. And yet finance seems to be all about, Wolf of Wall Street. Finance attracts greedy bastards. And most teenage girls don't aspire to be greedy bastards. And there is a kind of subtle, still, I think, a bit of a subtle sexism that we kind of feel okay if our boys want to grow up to be greedy bastards, but we don't feel okay about our girls. Our girls should want to do things that make the world a better place. So I think there's partly reframing around that. The number one, finance should not be about greed and getting rich yourself. Finance should be about solving the problems of the community by using finance to do that. And so girls should be able to feel prouder about going into finance, and that going into finance is not just because they want to enrich themselves, but because they want to solve problems. To solve global warming and decarbonisation, most fundamentally, it is a problem of capital allocation. The world needs to invest $100 trillion. So if you are someone in high school who really cares about the world and how can I make a difference, you can actually make a difference by being in finance and helping to direct $100 trillion to the places it needs to go to decarbonize the world. But that message is never articulated, never gets through. We never connect that higher ideal. We think of finance of the return that the shareholder gets rather than the value to society from capital being allocated efficiently to where it needs to go. But that is as much a role of investment and capital deployment, it's not just about making a return for shareholders, it's making sure that the right things get funded. And we never talk about that side of it either. So, finance has a branding problem. And it does itself no help because, we get the movies like Wolf of Wall Street, and then we get people out there who kind of seem to want to prove it's true. So we don't do a great job on that. And I think also, high school girls think if you go into finance, you're staring at Excel all day long. And it's not. Finance is a very people-oriented business. You sit with the CEO, you talk with them, you understand what's going on in the business. Then you go back and crunch the numbers in your model. It's a lot more interactive and about the real world. And so I think that's another aspect of the kind of misbranding that's out there.
What a great answer. I said, Kate, before we started this call that we weren't going to run over an hour, but we have done that. So, look, thank you so much for joining us. It's been a really great conversation. I'm confident that everyone who listens will have, valued your insights and appreciate the time that you've taken. And I wish you the very best for the rest of the week, and hope to see you again soon.
Thanks, Stephen. It's been a lot of fun. Thank you.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.